It feels like the world has been on fire for years: pandemics, wars, political shocks, trade conflicts. Yet financial markets keep acting as if nothing serious is happening. Stocks rise, forecasts stay optimistic, and investors behave like crises are a thing of the past. But history whispers a different story. Over the last few years, major stock indices have doubled, recovered fast from corrections, and convinced many that modern markets have learned how to avoid real collapses. Inflation is supposedly under control, central banks are expected to ease policy, and growth forecasts still lean positive. Everything looks stable. Almost suspiciously so. When markets agree on optimism, disappointment becomes especially painful. Because financial crises don't disappear, they repeat. Capitalism has been around for centuries, and its entire history is a cycle of booms, bubbles, and breakdowns. So the real question, isn't it, will there be another crisis? The real question is, why do we keep acting surprised every time it happens? A financial crisis begins where money flows, in banks, markets, and credit systems. It can look like a stock market crash, a currency collapse, mass defaults on debt, or a sudden fall in real estate prices. Trust evaporates, institutions stop lending to each other, and fear spreads faster than facts. Even the strongest bank cannot return all deposits at once. Most of that money is lent out. So when panic starts and depositors rush to withdraw funds, the system cracks. Bank runs don't create crises, they amplify them, turning fear into a self-fulfilling disaster. An economic crisis hits the real world. Factories, jobs, incomes, and demand. Production falls, unemployment rises, and living standards decline. Prices may collapse or explode. Both outcomes destabilize society. In reality, financial and economic crises rarely come alone. One triggers the other, like falling dominoes. Think of the economy as a living organism. Finance is its bloodstream. If blood flow stops, every organ suffers. A problem in one industry may hurt locally, but a breakdown in finance affects everything at once. That's why financial crises are especially dangerous. Economic crises often come from unpredictable shocks. Wars, disasters, pandemics. Financial crises, however, tend to repeat the same pattern. The causes are painfully human. Greed, overconfidence, poor risk assessment, and weak discipline. Markets run on two emotions: greed and fear. During booms, greed pushes investors to take excessive risks. During downturns, fear forces them to sell at the worst possible moment. This emotional pendulum is one of the main engines of recurring crises. When prices rise, people copy each other. Nobody wants to miss out. Entire markets move not because of fundamentals, but because everyone else is buying. The same herd moves in reverse during crashes. Speed replaces thinking. Modern financial instruments are often so complex that even professionals struggle to fully understand the risks. This complexity creates systemic danger. When one failure spreads through the entire network, like a chain reaction. When institutions become too big to fail, they take bigger risks, expecting rescue. Bailouts may stabilize the system short-term, but they teach dangerous lessons long-term. Losses become socialized, while gains stay private. Today's financial world is deeply interconnected. Capital flows freely across borders. That means trouble in one country can quickly infect others. Globalization doesn't cause crises, it accelerates them. After every crisis, regulations tighten. Over time, markets recover, memories fade, and rules are weakened. Confidence returns. Someone inevitably says, "This time is different." And that belief sets the stage for the next collapse. Eliminated? No. Reduced? Yes. Financial education matters. Transparency matters. Strong institutions matter. Emergency reserves matter. International coordination matters. These measures don't cancel crises, they make them less destructive. Crises are not a malfunction of the system. They are part of how it works. They destroy excess risk, punish poor decisions, and reset expectations. Without them, growth would eventually stagnate. The goal, isn't it, to predict the next crisis? The goal is to be prepared. Build resilience. Avoid excessive leverage. Understand risk. Crises are inevitable, but panic is optional. If you want to survive the next financial storm, and maybe even benefit from it, Subscribe to this channel. Here we don't fear crises. We study them, prepare for them, and learn how to use them wisely.